Welcome to the Wealth Nation podcast. It is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. And today, we are diving deep into the latest financial trends and market shifts impacting your investments. And we are going to be talking about the hot topic this morning in all financial markets is the sudden dip in technology unit trusts, ETFs, and shares, and what it means for investors like you. So recently we find that technology shares are part of the various ETFs and unit trusts. They have long been the darlings of the market. Now we find that they've taken the back seat to the rest of the market. The NASDAQ, which is the top 100 companies in the United States minus financial services companies, is known for its heavy concentration of tech stocks. It has seen a little bit of a rebound slightly over the last few days. However, it's still down more than 3% from its record high on July 10th. So what's causing this shift? Well, the most recent driver is the news that the Biden administration is imposing stricter restrictions on U.S. semiconductor company exports to China. This policy shift could significantly impact sales and earnings for American chip makers, leading to a sell-off in chip stocks and a drop in the NASDAQ. But there is a silver lining here. So despite this recent dip, tech stocks have already outperformed many other sectors this year. And the NASDAQ, even though it's struggling with this dip, it boasts more than twice the percentage gain of other indexes such as the Dow for this year. So given the strong performance, some investors are taking profits and reallocating their portfolios to include more diversification away from non-tech stocks. Additionally, if we look at the outlook for sectors outside of tech, these sectors have been improving. So inflation rates are declining around the world, all right? And it's most likely that the United States Federal Reserve, the equivalent to the South African Reserve Bank, will be cutting interest rates this year. All right, the possibility of that happening has increased for South Africa as well. And we hear the economists talking about a rate cut next month from the Reserve Bank. Remember, if you need a review of your investment portfolio, I'd love to chat to you one-on-one. Click a link where you are listening to this podcast or watching this video, or go to my website. It's financiallyfabulousfemales.com. Click on the Invest tab and book a complimentary appointment and we can chat. So this will potentially lead to broader economic growth and rising profits across various industries. Because if we sit back and think about it logically, ourselves personally, if we are spending less on our borrowing costs, such as our bond, our cars, our credit cards, we have a little extra money to spend around the house, maybe go out a little bit more, boost our savings a little bit more. And obviously, wherever we spend, those companies are profiting. And it's the same on a countrywide scale. When there's more money to spend, the profits will rise in various industries. The political landscape is also shifting. My favorite president, President Trump, is gaining traction in the election polls, raising the prospect for tax cuts in the United States. And obviously, again, if you and I are paying less taxes, if businesses are paying less taxes, they have more money to spend within their businesses. We also see a rotation from tech to other sectors. And we do this a lot with clients. We see, the fund we're investing in is done well. Let's take the profits from here and invest somewhere else to diversify further. And with the rate cut on the cards, we'll find investors switching away from their traditional investment strongholds into other diversified sectors. For some time, we find that tech stocks have been the go-to choice for many amateur investors because in South Africa, we have a lot of the indexes that make it really easy for newbies to get into the tech market. Big tech companies like Amazon and Apple showing endless growth. All right, and could it possibly be a bubble? Well, despite the various risks, many of the world's most valuable companies are tech giants. In fact, they have their own category now. They call it mega cap. That's how big they are, making the sector a very, very attractive investment option, especially for new people that don't really understand the market, do not understand the cycles, and the booms and busts that occur and how to maneuver these accordingly. So the tech stocks, ETFs, and unit trusts often serves as a bellwether for the economy and the stock market. And during the pandemic, we saw tech stocks rise. For example, FANG stocks, Facebook, Amazon, Netflix, Google, along with Microsoft and Apple, propelling the S&P 500 by 400% from the 2009 lows, and the NASDAQ 100 by over 700% during that same time. All right, and this left other markets falling far behind. Things began to change once the pandemic started easing. People went back to work, less reliant on technologies such as Zoom, for example. Right, although it has become a big part of our lives now, but we're not completely dependent on them because we can talk to people face to face. We're not at home on lockdown watching Netflix all the time. Or if you're American, getting stimulus and spending all of that money on Amazon. So there has been some pullback. We also see geopolitical tensions in 2022, the Russian conflict. That's caused energy prices to increase due to the Russia conflict. Now we see that Middle East conflict and that rising interest rates to pull back on inflation. Whereas over the past 6 months, we've seen these tech stocks stumble. Tesla dropped by 30%, Microsoft 16%, Apple 13%, and at one point, we find that Amazon dropped by 39%. So between July and early August, there has been some recovery, all right, and we find that the Federal Reserve Chair, Jerome Powell, indicated that interest rates has reached a neutral level and indicating that it could be time for cutbacks. What we need to understand as investors is that tech ETFs, tech unit trusts, tech shares are typically high-risk investments. It's a very volatile environment. And in the US, they had the very stimulus measures that flooded the market with cheap money. And people that were not consuming chose to invest. And that kind of inflated a lot of shares in the US, these big tech shares, and crypto as well. In recent months, we see central banks across the world have withdrawn some of that cheap money, the ones that were paying their citizens that were on lockdown because they couldn't work. This resulted in the sector becoming overvalued. Some stocks remain very attractive investments. Investors should consider the current dip an opportunity to gain exposure to companies of interest, even funds of interest here. If you're already in these funds and you are down in the dip, I typically choose to invest more, but not to panic sell and get out of my investments. However, some analysts warn that the decline might not be over and the company earnings could come into focus in the US if the US faces a recession. Early morning news this morning, they're talking about a hard landing, a recession. All right, but as investors, we need to stay firm, not make any emotional decisions with our money. Stand our course, know what our long-term game is. Another thing to note is that tech companies have built strong cash reserves during the pandemic. Companies like Alphabet and Microsoft, they have the ability to expand and make strategic acquisitions in the coming months. A very important thing to note is outgoing President Biden signed the CHIPS Act, which provides $42 billion in subsidies over the next 5 years to boost U.S. chip production, with the goal to address the supply chain issues that happened during the pandemic and to reduce the reliance on countries like China and Taiwan. So much of the tech industry depends on semiconductors, and the higher cost of U.S. production, because, they have all their HR policies and minimum wage and all of that. So this will increase the price of those chips. And this raises the questions about global competitiveness and potential inflationary pressures. On the semiconductors, next in line on that is the chips. Next in line on this is the share prices. And obviously, the top layer of that chain are the various ETFs and unit trusts that we invest in, right? This act hinges on how quickly it can be implemented amidst the current shortages. And in light of these sort of developments, tech investors are best advised to stick on what they can afford. Don't take any high-risk jumps and buy big during the dip. Know what your end game is. Recognize that it could take time for tech stocks to see solid growth again. And remember that patience and diversifications are key as we navigate this evolving market conditions. All right, so that's it for this episode of the Wealth Nation podcast. Thanks for tuning in, and be sure to subscribe for more insights and analysis over the ever-changing financial landscape. Until next time, stay informed and invest wisely.